The latest high-profile IPO coming online is Shake Shack. Think of Shake Shack as the cooler, smarter, tastier, and more upscale burger joint. Basically the polar opposite of McDonald's. With all natural, hormone and antibiotic-free burgers, well-designed stores, and friendly, committed workers, which is exactly what you'd expect from a Danny Meyer vehicle. The concept is captivating in and of itself, but what truly draws me in is the numbers, which are better than any other public restaurant chain out there. In 2013, its average unit volumes, which is average annual sales for each restaurant, came in at $5 million, an astounding number that's more than twice the $2.2 million that a best-in-breed Chipotle generates. Shake Shack's domestic locations generate, listen to this, average cash-on-cash returns of 65%. That means the payback period for opening a new restaurant is less than 2 years. Talk about incentive. But the real upside here is all about the opportunity for new store growth. Shake Shack has said they intend to nearly triple their unit base over the next 5 years, meaning they could expand from 63 locations to about 190. In just 2015, Shake Shack plans to open 10 new stores, which translates into 40% unit growth, among the fastest in the industry. As for valuation, I'm very comfortable paying 5.5 times forward sales, which implies a $25 share price. It's a 36% premium to the midpoint of the offering range. I expect shares to fly as soon as it hits the market, so it might be worth waiting for a pullback to get in. Either way, the stock looks as delicious as the burgers it serves. For The Street, I'm Jack Mohr in New York.